Hello, my name is Miguel Sanchez, and this is Miguel Sanchez World. And today I will be reacting to Tom Bilyeu, Arthur Hayes on Impact Theory, talking about when Bitcoin will become $1 million coin, meme coins, all kind of interesting stuff for business owners to know, innovators to know. So let's get started.
Please welcome back.
Thanks for having me. Glad to be here.
Dude, always a pleasure, especially at this point in the cycle. I think today's episode is going to be a lot of fun. I like to think that 100K Bitcoin is the demarcation point of where any naysayers is just dead. Like that conversation is over. You've got your straggler and Peter Schiff, who's just not going to let it go. But it really seems like that argument just doesn't make sense anymore with the level of institutional adoption that we have, the height of the amount. So for it to get to $1 million, where is the capital flowing? Is it purely from people that are aware that inflation is happening, or is this a continued cultural momentum of adopting a new asset class?
So Bitcoin at the time of this recording is about 97K. If you are an entrepreneur or anybody that's an early adopter, hopefully that's my audience, you have possibly bought in, but if you haven't and you believe this coin will get to $1 million, why haven't you? Can you put it in the description? But why I'm bringing this up under business context. As a business owner, we take huge risks, and why not put some of your money into something else that has another possibility of gaining value for you? You have a business, but now you also could have these assets that if your business doesn't work out, and if your business does work out, you can have more freedom faster. So this is why this is so important. Listen to what Arthur says.
So the first thing people need to understand is that the price on the screen is the marginal price of the last trade. It's not every trade that's happened. And so it's the simple example is, how do you become a trillionaire? Well, you create some fictitious company with 1 trillion shares, and then you sell one of them to your friend for $1. Now you're a trillionaire, right? The marginal price is $1 on 1 trillion shares, therefore you're a trillionaire. So I'm not saying that there needs to be, $1 million traded every day at that Bitcoin price. I guess need $1 to trade at $1 million, and that's $1 million Bitcoin. And that informs our psychological perspective on what we think Bitcoin is worth.
So, do you think that's something that BlackRock wants? Do you think that's something they could easily make happen? Bitcoin at 1 million? I do. And I think that is the plan. When you look, even Bloomberg Terminal has started showing Bitcoin as one Bitcoin equals $1 million. So on the terminal, it shows it as point 0.1 Bitcoin. Point 0.1 Bitcoin of value, because one will equal 1 million. So these financial institutions are starting to set it up. Not financial advice, but this is what I believe is going to happen. And as entrepreneurs, as innovators, we have to think what is going to happen and how can we get in front of it so we can become as wealthy as possible, create as many jobs as possible. What he just said here, it doesn't have to mean there's 21 million Bitcoin sold for $1 million for Bitcoin to be worth $1 million. Only one needs to be sold for $1 million for Bitcoins to be worth $1 million. So that is very interesting, and most people don't know that.
So with that in mind, what I'm talking about is the marginal flows into Bitcoin. Well, the supply of Bitcoin is fixed. We know 21 million will ever be produced. However, as you have people like BlackRock, Michael Saylor at MicroStrategy, longtime holders like myself and others, people who are just getting into the game now and believe in a future path of Bitcoin over the next 5, 10, 15, 20, 30 years. Are they going to sell? Why would you sell Bitcoin for fiat currency if you implicitly believe that the US government and every other major government is going to increase the amount of that fiat currency ad infinitum? That's the reason why you got into Bitcoin. So as the price rises, there's less people who want to sell it.
This is why I created Stack. Actually, just want to jump in here. Like, subscribe, follow everywhere. But this is why I created Stack. The idea of buying an asset that you believe is going to go up in value. And if you don't believe that, Stack is not for you. If you don't believe Bitcoin is going to be worth $1 million one day, Stack is not for you. But if it is, and right now you can buy a Bitcoin at, even if you buy $5 of Bitcoin and in 10 years it's worth 20,000, why would you sell that $5 of Bitcoin to buy a coffee? You probably are better off borrowing off of that Bitcoin to buy the coffee and keeping that asset that will be worth millions of dollars one day. So, this concept, you can use it as a business owner, you can use it as a regular person. I saw a video where this guy was using his life insurance like this. He was buying life insurance, borrowing off of it to fund his business. This works with Bitcoin and Ethereum now. It works with stocks, S&P 500, but you have to decide which asset do you think will go up in value faster to borrow from. And for me, I think that's Bitcoin and Ethereum.
And if we have this institutional adoption through the ETFs and other sort of corporate finance vehicles, those are sticky forms of holding, which takes supply out of the market, which means it's very easy to have a very exponential rise in the marginal price of Bitcoin, the last traded price of Bitcoin. And so I think that's one facet of just how a microstructure of a market works when you have a fixed supply and a holding base that doesn't want to sell it against an asset that can be infinitely debased. And then the other side, you have the United States trying to reshort.
What he just said there was exactly what I just said. Why would you not keep the asset that's going up in value and borrow the asset that's going to be debased, meaning dollars? Dollars are going to go down in value because of inflation. So why not borrow the thing that's going to go down in value and have a loan in the thing that goes down in value against the thing that's going to go up in value? That's the whole concept. That's what the world runs on.
Industry issuing credit. You have China has a property bust and they want to protect their industry and they're starting down the path of quantitative easing. They just recently announced that they're okay with.
Quantitative easing means printing money, if you don't know. And when business has boom and bust cycles, right? Every business has up times, down times. Quantitative easing is good for business because that means they print up money and people spend that money, and businesses are the ones that reap that reward. So you want to be in the space where when people get money, they need to spend it on things that your business provides.
Allowing their currency to depreciate because they believe it's going to help them in their fight against the new Trump 2.0 tariffs. You have the European Union statesmen like Mario Draghi and Emmanuel Macron openly saying that we need to print more money to revitalize the European industrial base. And you have Japan, which continues to run the easiest monetary policy of any major developed nation. So if you take a look at the entire world in terms of the largest four countries and economic blocks, they all are printing money for various different reasons. That's only going to continue. It's accelerating, in fact. And so we have a diminishing supply of freely traded Bitcoin with an expanding supply of fiat currency looking for a home. And if we believe that more people are changing their mindset to say, okay, crypto, it survived 15 years. It's going to be here for another 15, 20, 100 years, whatever. I feel okay thinking that this is going to be a store of value. I can use it to pay for things when I need. Therefore, I'm going to take 2, 3, 4, 5, 10% of my retirement income or savings and now start buying this asset. And so all these things come together, and that's what creates a marginal price of $1 million per Bitcoin.
How fast do you think we get there?
If you have a 700 plus credit score, you qualify for Chase's new program where you can access up to 100.
I don't know, 3 to 5 years.
Now,
Okay. If Bitcoin gets to $1 million in 3 to 5 years, you're going to want as much of it as possible right now, right? So this is where, again, try to understand it. If you're a business owner and you don't understand Bitcoin and Ethereum, spend time, Google, ChatGPT, YouTube, understand it. Everybody pays the price they deserve because that's what they've done the research and tried to understand it. I saw Bitcoin at 30 cents. I didn't start buying it till it was $5,000. Again, and I am a tech guy. I have a business background in technology and I still didn't put the time in. So no matter what type of business you are an owner of or you work in, the sooner you understand this. Again, I tend to believe it's not going to be 3 to 5 years. I think it's probably more 10 years, 20 years. But even that, you buy a house, you pay a house for 30 years for the hopes that that house 3, 4, 5 X is the value that you bought it at. And that's a really good outcome. If you could buy a house that you thought would 10X in 10, 20 years instead of 30, how is that not better? That's why I and many others believe in Bitcoin and Ethereum. And there's other coins and stuff, but those two coins are the top two, and there's reasons for that. Look that up.
You had called in one of our earlier conversations, you had called 100K Bitcoin, which at the time I remember seemed very aggressive. Do you feel like you were pretty bang on with the timing to get to 100K?
Yeah, roughly, December-ish, we're here. It's 104,000 or whatever it is. We'll see what it ends at the end of the year when people do their sort of tax optimization sort of things. But I think, out of the many predictions that I've gotten wrong, I got this one right.
Well, yeah, I mean, look, I don't think anybody's going to get them all right, but directionally, this one seems like you've had your eye on it for a while. So when I talked to Michael Saylor, he really looks at Bitcoin as like a physical law of nature certainty that money wants to go from high entropy, where it can be inflated. There's all kinds of chaos happening to effectively the price. I don't know if he'd use that word, but certainly he uses entropy. And that it just naturally wants to go to a low energy state where there's less manipulation of the currency, where it's going to be more static from a buying power perspective. Do you see that same inevitability? Do you look at this as a physics problem, or is this the inflation cultural problem from your perspective?
Well, I think the economist who made it's a Gresham's law. You spend bad money, you hoard good money, right? So what's the bad money? The bad money is fiat currency, US dollar, euro, yen, Chinese yuan. What's the good money? Bitcoin, gold to some extent. And so what are people doing? They're spending the fiat, they're saving, they're hoarding the Bitcoin, the gold, right? And so I think that's called Gresham's law. Could be mistaken on that. So yeah, you could.
Okay, so coming back, the whole idea around Stack, and I know I'm talking a lot about Stack, but he's bringing up the full idea of why we created this thing. He brought up you don't sell the thing that goes up in value, you spend the thing that goes down in value. But what most people are doing right now is they sell their Bitcoin to spend the fiat. Most people don't know that you could be borrowing off of it. Why would you want to borrow? It's better not to have a loan. That's not always true. It's better to have a loan if you keep the asset that's growing in value higher and faster than the loan interest, right? So if you have a loan, let's take an example. You have $100,000 worth of Bitcoin, $10,000 worth of Bitcoin, and you need to buy a cell phone. The cell phone is $1,500. Is it better to sell $1,500 of your Bitcoin, now bringing your holdings down to 8,500 and buy the phone? Or is it better to keep 10,000 and borrow 1,500 to buy the phone? That 10,000 grows 20% a year, and your interest on your loan, let's say it grows 10% a year. Now 10,000 in 1 year turns into 12,000. Let's say it grows 20%. The interest on the 1,500 grows 10%. That's $150. So your 1,500 turns into not even 2,000, but your growth of your asset grew 2,000. So you're growing a smaller amount slower, and you're growing a bigger amount faster. That's the concept. Buy, borrow, die.
Put in a physics term, you can put it in sort of an economics term. You can take a look at what happened in sort of like Weimar, Germany during their hyperinflation during the 1930s in terms of people got their marks, they spent them as quickly as possible, but they were also hoarding gold because they knew that was a real money at that time. So we're seeing the similar sort of thing just starting today. And yeah, Saylor can put it in sort of a physics terms, but I think in sort of a social cultural norm, we've seen this before every time any major civilization has failed. And They always print money. They always debase the currency, whether you're in a gold standard or not. It's the same thing over and over again. If you read enough history, it looks the same. It feels the same.
The reason I delineate that is if this is a physics question, then Saylor's idea of getting, because he puts the base case over the next 21 years that Bitcoin's going to hit 13 million. I don't know how you feel about that number, but for him, it's you can create inputs and outputs and see how rapidly the money is going to go from sort of that bad state of fiat into the more sound physics money of Bitcoin. So he likened it to a waterfall. And it's like once the water starts pouring over the edge, you know, as long as the water line is above the channel for the waterfall, it is going to drain out back to equilibrium. It is a matter of physics for him. Whereas if it's cultural, then we are still open to what I heard Raoul Paul refer to as the path of most pain, because this is the thing that scares me when I look at this. Saylor is it's ballsy, man. Don't get me wrong. And I'm as inspired as anybody else seeing what he's done. But nothing seems guaranteed in the future. And so to treat it like a physical certainty, I don't know, man. I don't have the cojones, I guess.
And this is why when we developed Stack, we didn't only do Bitcoin because there's people who just believe in Bitcoin. And the truth is you can't you can't go 100% certainty of anything, right? Even the whole concept of Bitcoin and Ethereum growing over time, some people believe that, some people don't. But you got to put your money somewhere. Again, as a business owner, as a person who's generated millions of dollars through business, I didn't have millions of dollars left in my hands, but there was no other asset class where I can take the money generated from my business, put it in that asset class and easily borrow from it. And I believe that once businesses understand that this is possible, I can't even imagine a business that wouldn't want to do it because you're literally creating the value of your business that you get to keep. So again, I see that, but this is why we did Bitcoin and Ethereum. I don't know if Bitcoin or Ethereum are going to be the main thing. I tend to agree that Bitcoin is built in more of a way to have a faster rise in value, but Ethereum has so much more use case. So even the way we created Stack, we couldn't create Stack by using just Bitcoin. We needed Ethereum, and so do many other decentralized finance products. They're built on Ethereum because Ethereum does things that Bitcoin can't do. So in a way, you have to choose what you believe is going to happen, but you also can hedge that bet a little bit. The people who are all Bitcoin only, that's a risk I'm not personally willing to take. I'm having Bitcoin and Ethereum, but you can do whatever you want. But at the same time, what he's saying is the reason why Bitcoin and Ethereum I borrow off of. I don't only borrow off of Bitcoin.
I mean, I think you have to take Saylor with a pinch of salt and understand where his position that he's coming from. He is essentially issuing dollar denominated bonds and, I guess the infinite supply of again, and buying Bitcoin. And every 3 to 5 years, he needs to roll over a certain portion of his debt. And if his stock price is below the conversion price of his convertible bonds, he might have an issue. So yes, he wants the market to believe it's a physical certainty because then you're not going to question the ridiculous price that you're paying for his stock.
So this is interesting, right? He positioned him and his company as a treasury holder of Bitcoin. So his company does hundreds of millions of dollars of revenue. Any public company has to do that kind of revenue. So he's been a public company for many years. He figured out though, the cash I have on hand sitting in my bank account, I can't do anything with that cash better than putting it into a Bitcoin type asset. If I buy real estate, where am I going to buy this real estate? I got to hope I can manage it well and I have the right team to manage it. And hopefully it doesn't get hit by a hurricane or all kind of other problems real estate could have. Can't put it in securities because I'm a publicly traded company. So publicly traded companies can't buy securities. But privately held companies can. They just don't grow as fast as Bitcoin and Ethereum do. Um, I could put it in crypto, right? And Bitcoin is in when he did the study, Bitcoin was the safest bet. And might still be. I don't know. Um, so by buying the Bitcoin with the money that was sitting in his bank account, he's grown that money by a lot. And by owning that Bitcoin, his company now is a proxy for owning Bitcoin. If you're a person who only buys stock and you want to buy Bitcoin, right now what everybody's doing is they're buying MicroStrategy, his company, because it's like holding Bitcoin in a company that you don't have to buy Bitcoin to hold. He's doing it for you. So the strategy is he buys Bitcoin, puts it on his balance sheet, you buy his stock, he takes that money you used to buy his stock when he issues new stocks, buys more Bitcoin. As the Bitcoin grows, he borrows more to buy more Bitcoin, so he ends up getting more Bitcoin. And what Arthur's saying here is if the price falls, he can be in a position where he needs to convert those loans to pay back the loan. And if the price is down, it may not work out for him. But I see it as he's been buying so long that at this point he's always kind of up. He's either up on his early buys or his little bit later buys because he keeps buying at different levels. So if you go back to his first buys, he's up. So if the price falls here, he can just sell the ones he bought here to pay off this loan. And he'll always be able to repeat that. Of course, in history, this has not played out well. Leverage in general is a bad thing. But if you play it right and know your points of failure and protect that, I think it could work. We'll see. History will tell. I believe it could work. I built Stacked on this whole concept as well. So I believe it can work.
I'm more in sort of the cultural phenomenon sort of camp. For humans, we're going to in the short term, we're going to say, oh, wow, Bitcoin's a million, 100 million, whatever the number is. This is a physical certainty. This is the last cycle ever. You hear those sorts of things on the internet. But at the end of the day, we'll get ahead of ourselves. We'll forecast some crazy dystopian scenario, some crazy hyperinflation. And then if you start to underperform the craziness, then the price of Bitcoin looks a little bit high. Maybe it comes down a bit. And so I think that markets go up, markets go down. We as humans, we're over optimistic and over pessimistic. We're not at that stage yet, but I definitely could see at a point in the cycle where we believe that there is no way that fiat currency could ever fix any of these problems. Therefore, Bitcoin is going to infinity. You'll hear people saying this is the last cycle and all this kind of nonsense. And then the price will dump 90%. So I am more in the sort of cyclical nature of markets. That's the physical certainty in my respect, based on human nature.
Yeah, I think the safer bet is definitely on the human nature side. But I mean, look, shout out to Saylor. Obviously, at this moment in time, he looks phenomenal. It's unbelievable what he's done. So I'll use my words. I have a feeling he wouldn't love this description, but the way that I look at what he's done with a MicroStrategy stock, to what you were saying, is he's basically taken a normal stock with a treasury in Bitcoin, layered a casino on top of it so that people can come in and play whatever risk game they want to play. If they want the ultra high vol, he's got stuff on leverage. And so the volatility there is just absolutely whiplash manic. And so for people that want that extreme volatility, they can be in there. But he's also got things where he's stripped out a lot of the upside, but also a lot of the downside, and people can get into that. And so that move alone, almost regardless of what happens to Bitcoin in the long run, the genius of being the first Bitcoin treasury mover, layering that equities component on top of it, which is what I refer to as the casino, brilliant, absolutely brilliant.
100%. The treasury idea is going to go down in history, right? Like you got money sitting in your bank account. It's either your treasury, your payroll, whatever it is, taking a percentage of that, buying an asset that grows in value instead of the asset being taken away through inflation, which is what the dollar sitting there is. He's the first person to think of that and actually do it as a publicly traded company. I've been doing it as my startup, and as we have more money in our treasury than we have made in revenue because we've done this. Anybody could do it.
Yeah, absolutely. I think as somebody who loves, finance, what he's done in sort of a corporate finance situation with his convertible debt, how he's termed it out, how he used his access to the, corporate debt markets in, the United States to be able to issue 0% coupon convertible debt.
Yeah, so he's basically selling bonds to, he's selling, he's basically getting loans from his investors, basically, by issuing a bond. And I could be wrong about this, but I'm pretty sure I do understand it. By issuing a bond, people are buying it at a borrow interest. And if he can't pay it back, it just turns into shares of his company. But if he does pay it back, you made money plus interest. And he's using that money to buy Bitcoin. And as it grows in value, he has more of it. And because he's a publicly traded company with all the right licenses and everything, he can do this.
Is a genius move. He needs volatility. That's what you're trading. So go up, go down. Bitcoin needs to move. If Bitcoin stops moving a lot, then the MicroStrategy trade might get into a bit of trouble. But again, I wouldn't worry about that now. That's 3 to 5 years sort of down the road situation. Right now, it's the bull market. So when the music's playing, you got to dance.
Explain volatility to us. Why is it good?
So at the end of the day, what is life? Life is risk, right? Every moment that we exist in this universe, I wouldn't go so far as to say this, but some people say the universe is trying to kill you, right? You enter this world, you have no
we all
clothes.
lose, man, whether it's trying or not.
We all lose. That's why you got to work on the beach, because it's about enjoying the journey. The truth. We all live in a universe that's trying to kill us. That's crazy.
It gets us.
It gets us in the end, right? And so at the end of the day, we're trying to make these calculations all the time about how do I structure my life so that I can survive longer in this universe. And so at the end of the day, I want to have a strip of bets that where the upside, when I'm right, is greater than what I pay to take that bet intrinsically. So our life is a strip of options. And so the more volatile the situation, the more valuable the option. But the name of the game is how do I pay the least amount of premium as possible in life so that I make decisions where my, getting it right pays me more and sort of, feel good things versus what it costs me to take that bet.
So that is another connection back to Stack. What he's saying here is why we built this thing. Think about it. If you put in 10K, borrow 8, you've only really took a 2K risk to have 10K of assets. That is the limited downside, only 2K of risk, with 10K of upside. Right? That's the whole idea. Take minimal risk for higher reward.
And the name of the game is how do I pay the least amount of premium as possible in life so that I make decisions where my, getting it right pays me more and sort of, feel good things versus what it costs me to take that bet. So we live in a volatile universe. Volatility is our friend. Suppressing volatility is not natural. And so government says, hey, through my ability to have legalize violence and kill people because they don't follow my rules, I'm going to protect you. And so let me smooth out that life curve for you. Do what I say is essentially the name of the game for any type of government. And there is some benefit to that, but take it to the extreme, which is what central banks have done over the past 50 years or whatever it is. Then you start to get into this unnatural state where the volatility is so low relative to what the natural just ebbs and flows of life in this universe are. And then things just blow up, right? And so you think you're safe, and then you get a 2008 housing crisis, or you get, the European crisis in 2011.
So this brings up a lot of people ask, okay, what happens if the price comes down of Bitcoin, right? The idea of Bitcoin and Ethereum goes very down, very up. If you took out a loan against, so let's say we take that 10K example. You take a 10K deposit, borrow 8. You only got 2,000 really on the line invested. But you have this $8,000 loan. What we do at Stack is as the price is falling, we sell some of the Bitcoin and Ethereum to protect that loan against the collateral. So the price falls. If it falls all the way, you could end up all in USDC versus all in USDC loan, all USDC collateral. But then you can buy in at that lower price with the money you have in collateral. But you still lowered your fall, right? Because if you had all of it in 10K of Bitcoin and Ethereum without taking the loan, the price could fall 90%. Your 10K turns into one. By borrowing off of it, you've limited your risk because you got 8 out immediately. And then when it falls and we protect, you're still going to have more than $8,000 of collateral because you can't have lower collateral than loan. So you're also minimizing the down. So this is where, again, even if you just take the two and invest it, if the two comes down 50%, you have 1,000 now versus by doing this, you still got $9,000 against an $8,000 loan, which you already had that 8,000 and you were spending it. So it lowers your risk of downside and ups your upside option.
11, or you get the regional banking crisis in the US in 2023. And these are all symptomatic of governments saying, we're just going to print a bunch of money and suppress volatility. But volatility is natural. We want volatility. We want to construct a situation where we have volatile upside outcomes with capped downside. And that's really the goal.
Bam. You just said it. You want unlimited possible upside with capped downside. Exactly why we build Stack. The 10K has unlimited growth potential and limited downside potential because you already borrowed $8,000. So in that scenario, you've minimized your downside and still kept the potential upside.
And so that's what, Bitcoin and crypto really represents is there's this outcome where all the fiat money in the world needs to come into Bitcoin. Obviously, that's not going to happen, but you can think of that as sort of the extreme example. And your cost is the price that you pay today for Bitcoin. So some people paid $1 for Bitcoin back in 2010, and if they held on, now it's worth 104,000, right? But the most they could ever lose was $1. And so why wouldn't you take that bet? You know how much you're going to lose.
As it goes higher and higher, though, those bets become harder, right? Because if you put 10,000 and you lose 10,000 versus losing $1, this is where. But even I have people who have bought early on like that, and now they want to use it, but they don't want to sell it. So this is where borrowing comes in. Because again, if you buy Bitcoin straight, and when you want to spend it, you're gonna have to give it to somebody for dollars, or you have to give it to somebody to borrow from it. Versus if you buy it in a decentralized finance way, you can borrow off of it anytime you want, 24/7. Easy. No paperwork, doesn't touch your credit score, is non-recourse. So if you just leave it and never pay it back, nothing happens to you. And this is the power of decentralized finance.
It's the amount of fiat currency that you sold to buy Bitcoin. And so you can sort of self-select your risk profile based on your own situation. But there's always an amount of money that you can willing to lose to earn the 10,000, 100,000, $1 million X return on something like Bitcoin.
Where people go wrong is when they hear volatility, they think it's a one shot, as in, oh, either this goes to zero or it goes up to 104,000. But that's not the volatility that traders seek. The volatility traders seek is I want high vol in a day. I want it to whiplash up and down, up and down, up and down, up and down rapidly. And that way, here's how I read volatility. I want that rapid whipsaw up and down because I'm smarter than the moron that panic sold when it went down. And so I know I'm going to buy low and sell high. And the reality is that most people are the buy high and sell low guy. So given that hard fact of life, are people foolish to like the high volatility?
Well, people are foolish to like the high volatility and have a high frequency of trading. So what you described is somebody who was actively trading in a very volatile situation. There's a very simple example. It's called volatility drift. This is why you should never, ever, ever buy any leveraged ETF. They're terrible products. I should know I've structured many of them. So you essentially, if I take something that's 100, such a nominal price of 100, and it goes down 10%, goes down to 90, and then I go up 10%, I go up to 99. So I've, on an arithmetic basis, gone down 10%, gone up 10%, but I'm down $1. right? That's volatility drift. And so when you're day trading in and out, in and out, in and out, or using these products that are sort of these daily volatility resetting products, you're exposing yourself to what we call negative gamma or volatility drift. And that's not good. But if you
I looked up this gamma, this negative gamma thing, and this is why dollar cost averaging wins. And this is where I don't try to trade. I just dollar cost average into Bitcoin and Ethereum and borrow to pay expenses. I don't sell on this. If I'm going to play with meme coins or things like that, that's me knowing I'm gambling though. That's not investing. And this is where I think a lot of people combine that and think I'm investing in meme coins. If you're gonna sell the thing back and forth, that's gambling because you could have the wrong side happen to you and you get screwed. But if you're gonna buy an asset that you believe is gonna grow over time, dollar cost averaging is the best thing. Just buy it, hold it as long as possible, and if you buy it the right way, borrow off of it. So just study that.
you say I'm a buy and hold type of person, you're the Warren Buffett type of person, and you're going to compound over time by systematically trying to reduce your total, your expected loss if you get it wrong, but just keep stay in the game. If you stay in the game, then over time you should do well. But the more you trade, the more money you lose. And that's just a fact. And so I think the fallacy is, oh, I like high volatility. I want to go to the financial markets casino and start trading. And then obviously you fall prey to the simple nature of, like, as humans, we have no idea what the future holds. And so trying to trade in sort of like a very short time frame is a recipe to lose all your money. Of course, there are these few traders out there who are the standout exceptions to that, and they're sort of paraded across the financial mainstream media as, oh, look what this guy did.
100%. So like when I do this trading, when I know I'm gambling and more likely to lose than win, I also stack it. And I created a video, it'll be in the description, where I bought this meme coin, $50, $100. It went up to $2,000. And again, that's up 20x. So what I do, I sell it, borrow. I sell it, buy Bitcoin, Ethereum, borrow, and wait. And if the price falls back down, I buy back in and I get my original buyback, but I took my profits. And if then that value goes down and goes to zero, at least I got my original profits out and it's growing for me in Bitcoin and Ethereum. So I use these meme coin, these trading like gambling things to keep building up my Bitcoin and Ethereum portfolio because my idea is I want to get my portfolio to a number where I can borrow to live from it every year. That's the ultimate goal in building wealth.
You turn $1,000 into $1,000,000, day trading every day. Here's this system, do this, do that, pay me a bunch of fees, right? So day trading, unless you're very, very good at it, you will lose all your money. And yes, the volatility makes it fun. So if you approach it as an entertainment situation, like you go to the casino, you're going to play craps, you're going to lose money, but it's fun. I'm going to have some drinks, hang out with my friends. Approach financial markets like, okay, I'm going to go trade on my brokerage account or my crypto account or whatever, trade some meme coins. I'm having fun. My price of fun is the $1,000 that I'm going to lose over time, but it's fun because I know, yeah, maybe if I get really lucky, it could turn into $1,000,000.
So that's what I did. I started out with $100, $50, $20. Anything that I knew, if I lose it, I lose it. And if I saw any gains, like 10x, 3x, 5x, I took that, sold it, bought Bitcoin and Ethereum, borrowed to have cash to come back in the game. And the wallet is in the description as well of me just building that up through straight gambling. Like most people think they're investing, I'm actually investing by gambling in that wallet. And he's right. If you're just doing that, you're gambling all the way and you're going to eventually lose.
But over time, I'm going to lose $1,000.
Yeah, I think that's actually the accurate way to think about most of the, certainly the stock market, most of finance in general is that. And the more I study finance, the more I become convinced this is all a game of gambling. And it's just a level of sophisticated gambling. I won't derail us on that because I really get soapboxy about this. But I would just like to quote what you just said a second ago. The more you trade, the more you lose. Now, I don't know how much trouble
The more you trade, the more you lose. Just dollar cost average and borrow as much as possible. That's the best thing. Look it up many different places. Read all the books. Dollar cost averaging is the best thing to do. And if it's time in the market is better than timing the market. So again, as business owners, money comes to our hands. But if you could do the right things with most of that money, we can become wealthy very quickly. Study that.
Well, that's going to get you for distilling it down like that. But I think it's really important for people to understand that. Going on volatility. So what is it that makes for volatility? Is it somebody panics and sells? Is that the only thing that pulls the price down?
Well, the price can go up too. So I think people associate
up, I get more people want into a finite thing. But what I want to understand is to the downside. What makes somebody, because when somebody says high volatility, you're never going to get an only up. Obviously, everybody wants that. They want the only up volatility. I get it.
You got to think about it as what I'm sitting here in the middle of. Waves. Anything that goes up is most likely going to come down. The waves just keep coming up and down, up and down, up and down. So if you caught the wave up, or you're seeing it when the wave is up and you buy in there, it's most likely to come down and you lost at that moment. It's better to always try to buy when the waves are down, not when they're going up. And most people do the opposite.
That's the fantasy, but that's not the reality. So high vol traders are all for something that whipsaws up and down. So I want to know what causes the down, because I think it's someone losing.
Yeah, so it's basically the fear of loss and how you feel about losing money is stronger than the amazing feeling when you make money, right? So I'm more afraid of losing the $100 and making it than the joy I feel when I make the $1,000. And so as the fear of loss kicks in, oh shit, I need to make sure that I have this capital. Oh, that was my car payment. That was my mortgage. That was my kid's college fund. Maybe I shouldn't have been YOLOing on that meme stock. Let me just get out of this right now to like make sure that I have some of that capital left. And that's the natural human reaction, which causes you to just like jam that sell button as soon as you see things aren't going your way, which is obviously not what you should be doing. You should be able to wear the up and the down volatility and equanimity, but that's not human nature at the end of the day.